Imagine you are running one of the most complex and high-stakes construction sites in the world. Let's say it's like a multi-billion-dollar semiconductor manufacturing plant.
Right, the kind of sprawling project where every single hour is meticulously scheduled.
Exactly. Every dollar is budgeted. So picture a Tuesday morning, it's 6:00 a.m. You've got a crew of 50 highly specialized union workers just standing around, drinking coffee, staring at an empty patch of dirt.
Which is incredibly expensive dirt at that point.
Yeah, it really is. And why are they just standing there? Because a $100,000 boom lift, a piece of equipment that is utterly essential for them to do their jobs that day, well, it hasn't arrived yet.
And in that exact moment, if you're sitting in the site manager's trailer and you're sweating over the daily burn rate, you really don't care about the brand name painted on the side of that boom lift.
You do not.
You don't care about the intellectual property of the machine's hydraulics or, the software running its dashboard. You care about one thing and one thing only, which is the delivery truck that was supposed to drop it off at 5:30 a.m.
So it's completely binary, right? I mean, the machine is either there or it isn't. The work either happens or thousands of dollars basically evaporate into thin air while the crew waits.
Yeah, the entire labor budget for that day is essentially set on fire because of a logistical hiccup. It is terrifying if you are the one writing the checks.
Right. And that brings us to today's deep dive. Welcome in, everyone. Today we are taking a stack of buy-side analyst reports and we're putting a massive industrial player under the microscope.
We're talking about Sunbelt Rentals Holdings.
Yes, ticker symbol SUNB. And as of today, May 20, 2026, they have just re-domiciled to the United States and secured a primary listing on the New York Stock Exchange.
Which, is a massive corporate milestone.
Brr.
Redomiciling isn't just a simple paperwork exercise. It fundamentally shifts how the capital markets view them.
Oh, for sure. But we aren't here to just read a press release about a bell-ringing ceremony. No, we are diving into the really gritty details today.
Right. The mission today is to unpack a highly detailed, very comprehensive, and frankly, a very skeptical buy-side analyst report.
Exactly. We are trying to answer one overarching question for you, the listener. Is Sunbelt Rentals a good place for investment capital right now?
To set the stage a bit, Sunbelt is an absolute giant. They are the second largest equipment rental player in North America.
We are talking about billions of dollars in revenue here.
Billions, a massive physical footprint across the continent, and real tangible cash flow. But as you dig into the pages of this buy-side report, you start to see some real cracks in the grand narrative.
Yeah, specifically, we're looking at these worrying trends around margin compression and a business model that might be, well, dangerously reliant on what they call mega projects.
But before we can judge where the company is going, or if it is actually worth deploying your capital into, we have to understand what they do, and more importantly, the reality of their so-called moat.
Right. Because the core fact of this business seems pretty simple on the surface, but the actual mechanics are intensely complicated. I mean, Sunbelt operates a gigantic, highly diversified fleet of equipment.
They rent out everything from, small hand tools you might use in a bathroom renovation to massive earth movers that literally reshape landscapes.
And they do this in a highly fragmented market. But here's the thing. The equipment itself is mostly substitutable. A generator is a generator, right? A backhoe is a backhoe.
Exactly. If you are a contractor, a John Deere excavator that you rent from Sunbelt digs a hole just as well as the exact same John Deere excavator rented from a competitor.
Which brings us back to that 6.0 a.m. construction site analogy. The analyst report introduces this concept of an execution mode. And I kind of love this framing.
It's a great way to look at it because if you look at a software giant, their moat is technological. You put all your company's data into their software, you train your employees on their interface, and well, pulling it out would be an absolute nightmare.
Yeah, those are really high switching costs.
Right. But Sunbelt's moat is built on scale, clustered market density, and logistics. You have to think of it like a top-tier global delivery service.
So customers do not stay loyal to Sunbelt because the green or yellow paint on the machinery is somehow magical.
No, they stay because when you call Sunbelt, the truck actually shows up on time. And if a machine breaks down on the site, which, let's be honest, heavy machinery constantly does, a mechanic is dispatched immediately to fix it or swap it out.
It's a moat made of routing software, maintenance bays, and local depot managers, not, legal patents.
It's diesel, not digital.
Right. But I have to push back here, though, because this is where the skeptical report really digs in, and I completely agree with the premise. If the equipment is easily substitutable, if my crew can use a lift from Sunbelt just as easily as a lift from United Rentals or Herc, Isn't an execution moat inherently fragile?
That is the multi-billion-dollar question.
Because if I'm a competitor and I just buy more delivery trucks and hire like slightly better dispatchers in one specific city, doesn't your moat just evaporate in that zip code?
That's the foundation of the analyst's skepticism right there. An execution moat is absolutely real in the sense that it takes decades and billions of dollars to build the network density Sunbelt has. You can't just, spawn 1,000 maintenance yards overnight.
Yeah, the capital barrier to entry is huge.
It is. But you are entirely correct that it is a moat that must be re-earned every single day. If your local branch manager just has a bad month, or if a competitor opens a depot right across the street and poaches your best mechanics with a higher hourly wage, that moat narrows instantly in that local market.
There is no contractual lock-in forcing a commercial contractor to keep using Sunbelt if the service slips even slightly.
Exactly. It's a trench war. You are fighting for every single inch of territory every single day.
And this leads us to the financial reality check, because the top-line numbers, they look fantastic on a billboard. Total revenue and equipment rentals are pushing past the $8 billion mark for the recent 9-month period ending in January 2026.
Right. And if you stop reading the income statement right there, you think, wow, this is an unstoppable compounding machine.
So you can't stop reading there, obviously. When we look at the directional trends, which, let's be honest, matter far more to investors than the raw absolute numbers, the picture shifts dramatically.
It really does. Net income is trending downward. Operating income is down. EBITDA margins are compressing.
And crucially, this metric called fleet dollar utilization has slipped. It went from 55% down to 54% at the consolidated level.
Let's actually pause on that and define dollar utilization for the listener, because that seems like the absolute pulse of a rental business. If you don't understand that, you don't understand Sunbelt.
Yeah, go ahead and break that down.
So think of it like a hotel's occupancy rate, but measured in dollars instead of room nights. Dollar utilization essentially measures how much rental revenue a piece of equipment generates over a year relative to its original purchase cost.
Okay, so if Sunbelt buys a piece of equipment for $100,000 and it generates $54,000 in rental revenue over the next 12 months, your dollar utilization is 54%.
Precisely.
So when that number starts slipping from 55% to 54%, it means one of two things is happening in the real world. Either your equipment is sitting idle in the yard more often, meaning your hotel rooms are empty, or you are having to cut your daily rental prices to convince contractors to take the equipment out the door.
Yeah, and either way, it just squeezes the juice right out of your margins.
Right.
That is the exact dynamic at play here.
And in a capital-intensive business, losing even 1 percentage point of dollar utilization is a massive hit to the bottom line. Right.
Huge, because you still have to pay the interest on the debt you used to buy the equipment in the first place. You still have to pay the mechanics to maintain it. Your fixed costs stay totally rigid, but your revenue yield on those assets is shrinking.
So we have an $8 billion top-line machine, but the profits being squeezed out of every dollar are getting visibly thinner. That margin strain is a massive red flag.
It is. However, to be fair to management, they didn't just stumble backward into becoming the second largest player in North America. They built an empire to get here.
Very true. And to understand if this leadership team can actually steer through the current margin pressure, we need to look at how they constructed this platform in the first place.
Which is a fascinating corporate evolution. It provides crucial context for how their executive team thinks and how they might behave today when their backs are against the wall.
Yeah, because Sunbelt is not some hot new Silicon Valley startup that's scaled through viral marketing. It is actually the successor to a company called Ashtead, which started in the United Kingdom all the way back in 1947.
It's wild to think about. Post-World War II Britain, right? Just a small, plant-hire business renting out basic equipment to help rebuild infrastructure.
They were a local, unglamorous operation for decades, but the real turning point, the moment that defined the modern behemoth we are analyzing today, didn't happen until 1990.
Right. In 1990, this UK company makes a massive geographic pivot. They cross the Atlantic, and they buy a tiny two-store business in Charlotte, North Carolina.
And that little two-store business was called Sunbelt Rentals.
That was the strategic masterstroke of their entire corporate history. They recognized that the North American market was incredibly fragmented, massive in sheer physical scale, and just ripe for consolidation.
So the U.S. pivot is the true source of their economic identity today. If they
Ah,
hadn't bought those two stores in Charlotte, they would likely still be a mid-tier regional player in the UK, completely off our radar.
exactly. And from there, they entered this hyper-aggressive era of expansion. It wasn't just slow organic growth where they opened one store a year. They went hunting for big game.
They absolutely did. The analyst report highlights two transformational acquisitions that really define this era. First, in 2000, they bought Beat USA for roughly $500 million. dollars.
That single deal essentially doubled their U.S. revenue overnight. It expanded their footprint all the way to the West Coast and down into Texas. They went from being a localized Southeast player to a multi-regional force.
And then in 2006, they swung for the fences. They bought Nation's Rent for $1 billion.
Yes, that is the deal that made them a true national heavyweight in the United States. But look at the calendar. 2006 is a very specific, very dangerous year to be making a billion-dollar, heavily debt-fueled acquisition.
Especially in an industry that is entirely dependent on construction and real estate development. If I'm management in 2008, looking back at that 2006 deal, I am sweating bullets.
Oh, absolutely.
You buy a massive, sprawling company right before the great financial crisis. That is walking into a trial by fire, residential construction ground to an absolute halt, commercial real estate financing just evaporated, credit markets froze entirely.
It was a nightmare scenario for a highly leveraged rental business.
My first instinct, if I'm holding $1 billion of fresh debt and nobody's building anything, is to panic and fire sale the equipment just to make the interest payments. Is that what they did, or did they find another way out?
Well, the way they survived that crucible shaped the company's entire modern DNA. They didn't fire sale the equipment, primarily because in 2008, nobody was buying used equipment anyway. The secondary market just completely collapsed.
Right, so couldn't sell it even if you wanted to.
Exactly. So what the integration of Nation's Rent during the GFC forced management to learn was a very painful, very vital lesson about capital structure and operational bloat. They realized that pure empire building, just buying massive, messy competitors for billions of dollars was incredibly toxic in a highly cyclical industry.
Because when you buy a giant competitor, you aren't just buying their revenue. You inherit their bad locations, their aging, poorly maintained equipment, their cultural issues.
All of their bad management habits.
Yeah, all while the macroeconomy is collapsing around you.
Precisely. They survived the recession by fiercely protecting their balance sheet. They slashed new equipment purchases to zero to hoard cash, and they just grinded out whatever rental revenue they could.
Wow, cut it to zero.
Yeah, but when they emerged from the other side of the GFC, their entire playbook had changed. They completely abandoned the mega merger strategy. Instead, they moved to a highly disciplined, localized approach.
Okay, so what did that look like in practice?
They focused on same-store growth, opening brand new locations from scratch, which they call greenfield expansions, and buying tiny local single-city rental shops, which they call bolt-on acquisitions.
It's a much smarter way to build density. Instead of swallowing a massive company and spending 3 years fixing their cultural rot, you just build a new facility across town and hire the best people locally.
Much lower risk.
Now, I want to focus on the leadership through this era because the continuity at the top is remarkable. Brendan Horgan's rise is critical to this narrative.
It really is.
He became Chief Operating Officer of North America in 2003. He ran North America through the grueling 2010s, became the group CEO in 2019, and today he is the CEO of the newly redomiciled Sunbelt Rentals.
So he has basically been at the steering wheel in one
Yeah.
seat or another for over 2 decades.
Yeah, and that operating continuity is generally seen by the market as a massive positive. The buy side loves leaders who have actually run the field organization.
They love it. Horgan knows what it smells like in a maintenance bay. He knows the granular unit economics of a single branch. He has navigated the GFC, the 2020 pandemic shock, and multiple minor economic cycles.
It proves to investors that this isn't some short-term promotional regime brought in by private equity to, pump up the margins, slash costs, and dump the stock.
Exactly.
Hmm.
But there is a flip side to that.
Well, yeah, let me offer a counter theory. I see the appeal of that narrative, and continuity sounds incredibly safe on paper. But if you have the exact same leadership team that built the model over the last 20 years, doesn't that also mean they are hopelessly tied to the embedded flaws of that model?
Oh, that is a phenomenal observation.
Like, they can't exactly play the turnaround card and blame the previous guy for their current problems. They built the machine. If the gears are grinding, it's their fault.
It is exactly the double-edged sword the analyst points out. Horgan's tenure proves unquestionable operational competence, yes. But it also means management entirely owns the heavy capital intensity of the business.
Right. They can't blame anyone else.
They own the persistent, historic temptation to overexpand their fleet. And crucially, they completely own the currently weak operations back in their original home market of the UK, which is currently acting as an anchor, dragging down their overall consolidated returns.
We'll definitely get into the UK mess in a minute, but you cannot deny the sheer physical scaling they've achieved in North America. The report outlines these eras of growth. Sunbelt 1.0, 2.0, 3.0, and now 4.0.
Yeah, the physical footprint expansion is staggering.
Coming out of the Great Financial Crisis, they had roughly 460 locations. Today, under the Sunbelt 4.0 initiative, they have around 1,600 locations. They have essentially blanketed North America.
It is an incredible feat of operational scale. Very few companies can manage 1,600 highly localized physical depots without collapsing under their own bureaucratic weight.
But as we pivot to the present day, the question for the listener, the investor, has to evolve. The question is no longer, can Sunbelt get bigger?
No, they have unequivocally proven they can do that.
Right. The question now is getting bigger still generating superior economics? Wait, if the general tool segment is stalling out and the UK is a mess, how is this massive machine actually making its money today?
We really need to look under the hood of their current revenue engine, because the reality seems quite different from the glossy marketing brochures they hand out to investors.
So let's break down the segment mix. If you read their corporate materials, Sunbelt is framed as a, quote, diversified solutions platform.
It sounds very modern.
Very resilient, very tech adjacent.
Yeah. But when the analyst breaks down the actual revenue streams, a deeply traditional, heavily skewed picture emerges.
The reality is that the North America General Tool segment is the absolute ballast of this entire enterprise. It represents roughly 70% of all their equipment rental revenue.
70% is massive.
It is. Then you have North America's Specialty, which is a smaller but critical growth engine sitting at around 19%. And finally, you have the UK operations lagging far behind at around 11%.
Let's actually define these categories clearly so we understand the different economic drivers. General tool is exactly what it sounds like. It is the yellow and orange iron you see on every job site.
The basic stuff.
Right. It's the backhoes, the forklifts, the scaffolding, the standard boom lifts, the small excavators. It is the commoditized equipment that every single general contractor needs to build a strip mall, a warehouse, or a residential subdivision.
Okay, so what makes Specialty an entirely different beast?
Specialty isn't just renting out a piece of metal. It's renting out an engineered solution. We are talking about massive climate control systems designed specifically for hyperscale server farms.
Oh, wow.
Or heavy-duty, high-volume industrial pumps for municipal flood mitigation. Or temporary, complex power grids set up for massive outdoor music festivals.
Stuff that requires real expertise to install and run, not just a set of keys.
Exactly. And understanding that operational distinction is vital because there is a glaring, massive divergence in the unit economics between these two segments. They're technically the same company, but financially they're behaving like two completely different businesses.
And here is where it gets really interesting and honestly a bit alarming if you are holding the stock. Let's look at the actual data trends. General Tool, which again is the heavyweight champion of the company at 70% of revenue, has essentially stalled out.
Stalled out completely.
If you look at their same store and greenfield growth for General Tool, it is sitting at less than 1% recently.
Less than 1%.
And the return on investment, or ROI for General Tool, is dropping sharply. It fell from over 25% down to 20.2% in a recent fiscal year.
Meanwhile, the specialty segment is doing the exact opposite. It is booming. Rental growth in specialty is up 8%, earnings are climbing steadily, and the ROI in the specialty segment is hitting 30%.
30% ROI is incredible.
It is a vastly superior economic engine, generating incredibly high returns on the capital deployed.
I look at this business like a massive, sprawling restaurant. General Tool is your meat and potatoes. It isn't glamorous, it doesn't win Michelin stars, but it is 70% of your daily orders.
It keeps the lights on.
Exactly. It is what pays the rent on the building, and it absorbs all the heavy fixed costs of having a kitchen staff, dishwashers, and mechanics in the back. Specialty, on the other hand, is your high-margin dessert menu, the soufflé.
The soufflé, I like that.
It is incredibly profitable, and the people who order it love it. But if your everyday customers are slowly stopping their orders of meat and potatoes, can you survive as a massive restaurant just selling soufflés?
That is a brilliant way to conceptualize the structural risk. The overall business ROI is still respectable, hovering around 14.5% corporately. But the direction of travel is what terrifies the analyst. The high-margin dessert menu is increasingly having to carry the weight of a massive, stalling meat and potatoes core.
Why is General Tool stalling so badly, though? I mean, is it just competition, or is the macro environment turning against them?
It is heavily macro-driven. General Tool is tethered to local commercial construction, the everyday strip malls, the local office park renovations, the regional warehouses.
Right.
And that sector is incredibly sensitive to interest rates. With interest rates staying sticky and higher for longer, local developers simply aren't breaking ground on as many new projects. Financing is too expensive.
So demand for standard forklifts and backhoes softens, which drags down that dollar utilization metric we talked about earlier.
Precisely. And management obviously knows this. They aren't blind to their own balance sheet.
So what is the narrative they are spinning to Wall Street to keep the stock price up?
Their argument leans heavily on total addressable market, or TAM. They argue that right now, their market penetration in specialty is only around 10%. They're telling investors, don't worry about General Tool, look at specialty. We can double this penetration.
They're mapping out a confident path to take specialty revenue from roughly $5 billion up to $10 billion.
Which sounds incredibly enticing. A path to an extra $5 billion in high-margin revenue is a great slide in a pitch deck.
Oh, it looks great on paper.
But if we connect this to the bigger picture and apply that skeptical framework, we have to look closely at what that projection actually requires in the real world. The analyst cautions listeners on how to underwrite this promise.
Because it's not a guarantee.
Not at all. For Sunbelt to hit those massive specialty targets, management is implicitly assuming two distinct things will happen at exactly the same time.
I'm guessing neither of those things is guaranteed.
Far from it. First, they are assuming structural market penetration gains, meaning more companies decide to rent specialty equipment instead of buying it themselves.
Okay, that's one.
Second, they are assuming market share gains, meaning Sunbelt actively steals existing rental customers away from their competitors.
Assuming both structural shifts and massive competitive wins happen simultaneously in a maturing market is deeply aggressive.
Extremely aggressive.
That is modeling a perfect world where nothing goes wrong and competitors just don't fight back at all.
Exactly. The report clearly states that in a skeptical framework, that is an upside scenario. It is not a guaranteed baseline that you should build your core investment thesis around. You don't price a stock for perfection when the core 70% of the business is actively slowing down.
And we haven't even touched on the UK segment yet. This is the company's birthplace. This is where Ashtead started in 1947.
Yeah, their roots.
But right now, the UK is a massive drag. It is producing a dismal ROI in the mid-single digits. Management admits it requires a full operational restructuring. Why is the UK such a mess compared to North America?
It's a combination of systemic issues. The UK market has a fundamentally different competitive landscape. It is even more fragmented, but with fierce local price competition.
So margins are just naturally lower.
Right. On top of that, you have higher structural costs, different labor union dynamics, and the broader macroeconomic reality of the UK post-Brexit, where inflation has severely dragged down major construction initiatives.
The demand profile is choppy, and the cost to serve that demand is stubbornly high.
Exactly. Which raises an incredibly important question about capital allocation. If you have a business unit generating 6% returns in a global environment where risk-free interest rates are hovering around 5%, you are essentially destroying economic value every single day you keep that unit open in its current form.
That is the harsh financial reality. The capital tied up in UK excavators would literally generate a similar return just sitting in a treasury bond with none of the operational risk.
None at all.
So let's summarize the operational reality right now before we look at the balance sheet. The core General Tool segment, 70% of the revenue, is showing stalled growth, dropping ROI, and compressing margins due to macro headwinds.
Yep.
The UK business is a legacy anchor destroying economic value. The specialty business is fantastic, but management is promising the moon to keep the overall growth narrative alive.
That is the sober, unvarnished operational summary.
If that is true, well, if margins are compressing and the core business is stalling, how on earth did this company just report such massive, eye-popping free cash flow numbers?
Ah, yes.
The filings show over $1.4 billion in free cash flow for the recent 9-month period. Those two facts, stalling core growth and exploding cash flow, do not logically align.
That is the magic trick of rental accounting. The analyst explicitly calls this the cash flow optical illusion. To understand why $1.4 billion isn't quite what it seems, we have to explain the deeply cyclical mechanics of gross rental capex.
It's like claiming you saved $5,000 this year because you decided not to fix the leaking roof on your house or change the oil in your car.
That's a perfect analogy.
Yes, your bank account looks fantastic today, but you haven't actually generated new wealth. You were just borrowing that money from your future self, and eventually the engine is going to blow or the roof is going to cave in.
In a heavy equipment rental business, the single biggest cash expense, by a mile, is buying new equipment. Buying new excavators, new lifts, new generators from manufacturers like Caterpillar or John Deere. This is known as gross rental capex.
Okay, so that's where all the cash usually goes.
Right. Now, if the economy softens slightly, or if management gets nervous about margin compression and dropping dollar utilization, what is the absolute easiest lever they can pull to protect their balance sheet? They simply stop buying new fleets.
So the hundreds of millions of dollars that normally go to John Deere just sit in Sunbelt's bank account.
Precisely. The recent massive spike to $1.4 billion in free cash flow, which was up from less than $800 million the prior year, was largely driven by a significant intentional drop in rental equipment purchases.
They aggressively cut capex from over $2 billion down to $1.4 billion.
Right. So yes, that is real, tangible cash in bank. It is not accounting fraud, but it is a complete illusion of long-term operational health. Because if you stop buying new equipment, your existing fleet gets older every single day.
And as the fleet ages, the maintenance costs inevitably rise. You need more mechanics, more spare parts, more downtime, and more importantly, your execution moat, that delivery truck showing up on time with a working piece of machinery, well, it starts to fracture.
It definitely does.
If you send an aging boom lift to that 6:00 a.m. construction site and it breaks down at 10:00 a.m., the site manager doesn't care about your free cash flow metrics. He calls your competitor.
Exactly. You cannot run a rental business indefinitely on aging iron. Free cash flow always looks its absolute best right when a capital-intensive business stops investing in its own future.
That is such a key point.
That is why the analyst insists that sophisticated investors must normalize cash flow across the entire fleet cycle, not just look at a single 9-month snapshot.
Yeah.
And the proof that this is temporary is right there in management's own recent filings.
They have already raised their forward capex guidance back up to over $2.2 billion.
They have. That $1.4 billion cash flow spike is going to normalize right back down.
That brings us to the most critical issue for shareholders, capital allocation. What is management actually doing with the cash they generate, whether it's illusionary or real? The company has a stated public hierarchy for capital allocation.
Right, let's go through it.
Priority 1, organic fleet growth, buying new machines. Priority 2, greenfields, opening new locations. Priority 3, bolt-on M&A, buying local mom-and-pop shops. And finally, priority 4, shareholder returns, which means dividends and stock buybacks.
That is a very rational textbook framework.
Yeah.
If they followed that exact hierarchy strictly, prioritizing high-return investments first, the buy-side analyst would have very little to complain about.
But the reality of their spending tells a slightly different story, doesn't it? This is the skeptical buyback question. Sunbelt is currently executing massive share buybacks. We are talking over $1 billion returned to shareholders recently, while also maintaining a progressive dividend.
And here is where the tension lies between management's actions and the skeptical investor's framework.
Well, Abe, let me push back on management's logic here, because this is the crux of the whole skeptical view. Wait, if your core margins are compressing, your largest segment's growth is basically flat, your dollar utilization is slipping, and your UK business needs a ground-up restructuring, why on earth are you spending $1 billion buying back your own stock?
It seems counterintuitive.
Shouldn't you be hoarding that cash for a rainy day or aggressively reinvesting it to fix the UK and boost the general tool segment?
It is a phenomenal question.
Yeah.
Now, to be fair to management, we have to look at the balance sheet context. They are not in danger of bankruptcy. Their leverage, which is typically measured as the ratio of net debt to EBITDA, is holding incredibly steady at a very safe 1.6x.
Let's quickly clarify EBITDA for the listener. That stands for earnings before interest, taxes, depreciation, and amortization. It's essentially a proxy for the raw operational cash the business generates before the accountants and the taxman get involved.
Correct.
And a leverage ratio of 1.6x means their total debt is only 1.6 times their annual operational cash flow.
Exactly. In a highly capital-intensive industry like this, 1.6x is a very conservative, safe number. Furthermore, most of their debt is fixed rate at around 5%. They are not borrowing money at loan shark variable rates just to buy back stock. They've demonstrated capital discipline on the debt side.
Okay, so they aren't being reckless. They aren't leveraging the company to the moon.
They aren't reckless, no. But aggressive buybacks during a period of operational softening raise the bar for trust tremendously. If you are a CEO buying back your own stock, you are telling the market, we believe our shares are deeply undervalued, and we don't have any better internal projects that can generate a higher return than simply buying this stock.
But wait, earlier we established that their specialty segment generates a massive 30% ROI.
And they did.
If that is true, why not pour that entire $1 billion into dominating the specialty market even faster? Why not open 50 new specialty greenfields tomorrow?
You've hit the exact contradiction. If the highest return uses of capital are greenfields and specialty fleet, then maintaining a $1 billion buyback cadence while your overall margins compress feels, well, questionable.
It really does.
It suggests one of two things. Either they are quietly running out of high-return places to put the money physically, maybe the market isn't growing as fast as they claim, or they are trying to financially engineer earnings per share growth because their organic top-line growth is slowing down.
Right, because when you buy back shares, the overall profit is divided by fewer shares, so the earnings per share goes up, even if the business itself isn't growing.
As the analyst puts it, capital discipline is present, but capital certainty is not.
Management is betting heavily on themselves. They are assuming they can out-execute the macro environment and that their current struggles with General Tool are just a cyclical blip. But what happens if the competitors wake up? Or what if the macro environment simply stops cooperating altogether? Sunbelt does not operate in a vacuum.
Which brings us perfectly into the competitive landscape and the disappointment scenarios.
Let's talk about the battleground. The North American rental market is massive. The conservative estimates put the total addressable market in the low $90 billions. And overall rental penetration, meaning the percentage of equipment on job sites that is rented versus owned outright by the contractors, is around 55 to 60%.
And within that massive pie, Sunbelt holds about an 11% share of the market.
Which means 89% of the market is held by someone else. There is massive room to grow, but the competition is not standing still waiting to be consolidated.
Definitely not.
The largest player in the room is United Rentals, commonly known as URI. They hold about 15% of the market, and the competitors below Sunbelt are getting highly aggressive.
This is a crucial development that threatens Sunbelt's scale advantage. Just recently, a competitor named Herc snatched up a massive asset package from another regional company called H&E.
That was a big deal.
Huge. That deal added 160 branches to Herc's network almost overnight. That materially improves Herc's competitive posture. They suddenly have more density, more equipment, more reach, and a better ability to service large, multi-state contractors.
It is like being in a foot race.
Yeah.
The track is getting wider because the overall market penetration is growing, but the runners next to you are putting on running spikes and hitting the gym. You are getting faster, but they're getting faster too.
Great analogy.
Scale matters, obviously, but the scale premium, the extra profit margin you make simply by being bigger and more dense than the other guy, has to widen fast enough to generate superior returns. And right now, Sunbelt's margin data says that scale premium isn't widening.
It is stalling. A fragmented market helps scaled players like Sunbelt initially because they can easily crush mom-and-pop shops. But fragmentation is not a moat in itself. If United Rentals and Herc keep consolidating the smaller players, suddenly Sunbelt isn't fighting local, undercapitalized shops anymore. They're fighting well-capitalized, highly sophisticated national and super-regional rivals.
Let's walk through the failure scenario. And I want to be crystal clear here. We are not talking about bankruptcy. We are not talking about the company going to zero or defaulting on its debt.
No, the balance sheet is too strong for that. The leverage is 1.6x. They easily survive a standard recession.
What we are talking about is an investment disappointment scenario. The inference the analyst makes is fascinating because it is so incredibly plausible. It doesn't require management to be grossly incompetent, and it doesn't require the global economy to crash.
It just requires a few normal cyclical things to go wrong at the same time. Let's build that scenario piece by piece.
Go for it.
First, Management currently leans heavily on mega projects, things like semiconductor plants, EV battery factories, and massive infrastructure bills funded by government spending. What happens if those mega projects get delayed by regulatory red tape, or localized inflation, or shifts in political administrations that freeze federal funding?
Boom. That massive tailwind softens instantly, leaving a glut of heavy equipment sitting idle.
Second, local commercial construction, the everyday strip malls, office renovations, local warehouses, stay soft for longer because interest rates remain sticky.
That hits the core general tool segment right in the teeth, driving dollar utilization down further.
Third, used equipment values drop. Remember, rental companies eventually age out and sell their old equipment on the secondary market. It's a key source of cash.
Right, they flip the old iron.
If the market for used backhoes drops by 15% because supply chains have normalized and new equipment is cheaper, that hits their cash flow directly.
And finally, what if the UK restructuring yields no real benefits? What if it is just a chronically bad market for them due to structural labor and inflation issues?
If those four things happen simultaneously, mega projects delay, local construction stays soft, used equipment drops, and the UK drags, Sunbelt remains a perfectly competent operator. The delivery trucks still show up, the mechanics still fix the lifts, they still generate cash.
But they generate mediocre, low-growth returns for shareholders who buy in at today's premium valuation.
That is the ultimate risk. It isn't a spectacular explosion, it is the death of 1,000 cuts to your investment yield.
You buy in expecting a compounding, high-growth engine, and what you get is a mature, capital-intensive cyclical business fighting a brutal, low-margin trench war for market share.
And your stock multiple compresses, and your capital is basically dead money for 5 years.
You are paying a premium price for a business that might be facing very average, unexceptional growth over the next 5 years. Well, we've covered a massive amount of ground today.
We really have.
We've looked at the sweaty, diesel-fueled execution moat. We explored the fascinating history from a small UK plan hire to a US giant tested by the 2008 financial crisis.
We dissected the glaring divergence between the stalling general tool segment and the booming specialty segment.
We revealed the optical illusions hiding in the free cash flow metrics. And we mapped out the rising competitive risks and the plausibility of a multi-front disappointment scenario. Let's pull this all together for the final verdict on Sunbelt Rentals.
The overarching question we started with was, is Sunbelt a great business or a good business? The analyst concludes, and the evidence we've discussed strongly supports, that it is a good business.
A very solid operator.
They have a strong, cycle-tested management team. They survived the GFC. They know how to operate heavy machinery logistics better than almost anyone on Earth.
But under a skeptical buy-side framework, it does not currently clear the bar as an exceptional investment for fresh capital today. Good is not always a good investment if the stock price and the market expectations require greatness.
Precisely. Let's recap the three most critical themes from this entire deep dive. Number one, execution over structure. Sunbelt's moat relies entirely on daily, grueling logistical execution. It is not customer lock-in, it is operational density.
They have to wake up every day and be the best delivery and maintenance service in town, or they lose the business to United Rentals or Herc.
Number two, the segment split. You cannot look at their $8 billion top line as a single, healthy monolith.
Right.
The specialty segment is the shiny object carrying the growth narrative, but the massive underlying general tool segment, which is 70% of the company, is showing real margin compression and stagnant organic growth.
The meat and potatoes are getting cold.
And number three, capital allocation scrutiny. The strong $1.4 billion free cash flow they reported recently is slightly inflated by a temporary, intentional pause in buying new fleet.
Therefore, executing a massive $1 billion share buyback program during a period of operational softening is a point of heavy scrutiny. They are prioritizing financial engineering over keeping their powder dry in a cyclical industry. Which brings us to the end, but I want to leave you with one final provocative thread to pull. Something you won't see in the headline numbers, but is crucial for anyone thinking about investing in this executive team. It's the governance angle.
The governance angle is fascinating here.
Because Sunbelt just redomiciled to the U.S. in May 2026, we are currently looking at a transitional set of SEC filings. We are still waiting for a standalone U.S. 10K and, more importantly, a DIF 14A proxy statement.
For the listener who might not read SEC filings for fun, the DF-14A is the document that forces a U.S. public company to reveal exactly how management is compensated, what specific metrics their bonuses are tied to, and how their realized pay actually aligns with shareholder returns.
Right now, based on preliminary filings, we know the CEO has a base salary of about $1.1 million, but his long-term incentive awards can be up to 850% of his salary.
Wow. That is massive, extreme leverage on his performance.
But what specifically defines that performance? If his bonus is tied simply to top-line revenue growth or heavily adjusted EBITDA, it deeply incentivizes him to expand aggressively, buy up competitors, and boost the TAM narrative, even if the actual returns on that invested capital are mediocre.
When that U.S. proxy statement finally drops, it will give investors their first true, transparent look at how management's compensation truly aligns with the risks they are taking with your money. Are they paid to build an empire, or are they paid to generate exceptional returns on capital?
Until that transparency arrives, management deserves respect for the logistical empire they've built over the last 20 years, but they do not deserve a premium blind trust.
Well said.
It makes you wonder, though, as you step back and look at the broader economy. In a world increasingly dominated by artificial intelligence, cloud software, and digital ecosystems, are the last true, unassailable monopolies going to be the companies that simply know how to move massive pieces of heavy steel from point A to point B better than anyone else?
It's a great thought.
You can't write code to dig a foundation. Next time you drive past a massive construction site, look at the yellow and green paint on the machines and ask yourself who is really making the money. Thank you for joining us on this deep dive. Keep questioning the narrative, look past the surface numbers, and we will catch you next time.